Chapter 9, market efficiency. Market efficiency you've heard of. Behavioral finance, maybe not. Okay, we're going to look at the efficient market, market anomalies, why it's efficient. We're going to look some at behavioral finance, which is kind of a soft area, not typically real comfortable for people who are used to quant. But it does come into play, and we're going to look at some technical trading rules. Okay, efficient markets. The basis here is the random walk hypothesis. You've all heard of the book, Random Walk Down Wall Street. It says price movements in stocks are unpredictable. Basically, that says you cannot predict ahead. That right there is the actual formula for a random walk. The best estimate of the next value for Y is the current value of Y plus an error term. That's it. And we base a lot on that because we always use historical data to forecast because we don't have anything else. Efficient markets. You looked at this back in previous classes. An efficient market, and they're talking about informational efficiency, it rapidly and fully incorporates new information. The key word there is new. We're going to look at the EMH, anomalies, and explanations. That's Walmart's quarterly revenue from 2000 to 2015. Those cute little red dots are probably Christmas. That's the revenue. Those are the stock prices. Did you see a relationship there? Nope. So just looking at how well they're doing doesn't relate to the stock price. The basis for EMH is that the market is informationally efficient, so you should not expect to earn abnormal returns on any kind of consistent basis. If you can't predict it, you can't earn abnormal returns. An abnormal return, when you hear investors and investments talking about searching for alpha, that's what they're searching for, abnormal return, getting more than you expected. That's alpha. There's your formula. The expected return is from CAPM. So if you get more than you expected, you got alpha. Their example, beta 1, risk-free rate 2, market return 10. We expect 10. If it returns 12, then we got 2% of abnormal return. The more information that's incorporated, the more rapidly it's incorporated, the more efficient the market is. Thanks to technology nowadays, it's pretty efficient. We're going to look at 3 forms of it. Weak form. Weak form says the study of past stock prices and volume of trading doesn't help you at all. Basically, that's saying that technical analysis does nothing. Charting, all that kind of stuff, does nothing. Stocks are just random. Best strategy, buy and hold. Semi-strong form says you cannot consistently earn abnormal returns on publicly available information. That says fundamental analysis. In other words, searching through all the data on a company isn't worth anything. Strong form says there is no information that allows you to consistently earn an abnormal return. That one's not true, because if you traded on private information, insider information, you can earn an abnormal return. It's illegal, but you can. So weak form is basically accepted to be true. Semi-strong is accepted to be true. Strong form is not. Strong form, just in your mind, if you had inside information and you could trade public and you could legally trade on it, you could make money. The problem is it's hard to catch people insider trading. That's harder than you think. The one I can think of they caught was a guy who worked in the publishing area for Barron's, and he saw it coming through the press before it went out. And he didn't trade. He told somebody in his family to trade. It's hard to find. Stock price reaction, positive earning news. There is an enormous amount of research in this area, actually in accounting, a ton of it in the accounting research area, because you're looking at earnings announcements. That's pretty much what it should look like. If that's times 0 right there, good earnings announcement, it bounces up and it adjusts. No leakage. That's leakage. If you see the price moving before the announcement, that's leakage. Somebody's leaked something about what the announcement's going to be. Arbitrage. Arbitrage actually, can occur. You can have two identical items selling at different prices in different markets. It isn't going to last long because arbitragers are looking for it. They're looking for it online, on the screen all the time. And their very action is going to force the prices back together. Arbitrage is basically simultaneously buying and selling the same asset at different prices to earn a risk-free profit. If you're online, you're basically buying and selling it right there. In the real world, these arbitragers do exploit that difference, and it forces prices back together because this can't last for long. Market anomalies, patterns that are inconsistent with efficient markets. There's a whole bunch of them. Calendar effects. The January effect. Small cap stocks outperform large cap in January, usually by a lot. There's a whole bunch of explanations for this. Portfolio rebalancing for taxes and just a bunch of stuff. It persists. The small firm effect. Small firms outperform large firms. They're riskier, but they earn more. Post-earnings announcement drift. Price adjustment continues. We saw that price adjustment. It went up and came back down and leveled off. Let me put this thing up. If it happens right there, that's leakage back there. That's post-announcement drift up and down. It's the tendency, if the announcement's good, it bounces and then it keeps on going. Or it drops and it keeps on dropping. Now, there's some behavioral explanations for that. Think of it this way. There's the announcement right there. People who are watching for it, waiting for it, and ready to react, trade right there, right at time zero, and move the price. Some of us don't react that quickly. We don't see it, we have to process it slower. So we don't react until over here. Some people, it takes longer because you're all reacting based on what you know. So the person who's been watching it every day, every minute, waiting for this, reacts. Some of the rest of us think, oh, wait a minute, I think that was a good piece of news. We ought to do something about it. So you've got to drift after that. The value effect. PE and market to book. Low PE stocks outperform high PE stocks. Now think about that. High PE stocks are typically ones where investors are expecting earnings growth, but they're probably not earning a lot. That's how come they've got a high PE. Low market to book outperform high market to book. In a lot of ways, higher compensation, higher risk. We all know that's there. Patterns may appear by chance, and that's how we get to behavioral biases. A lot of them, we all have behavioral biases, I guess would be the way to put it. When you read some of these, this is a whole branch of finance research agenda. It's on behavioral finance. There's a lot of evidence supports market efficiency. Our markets are very efficient, but there's an increasing number that casts doubt on it. There's an area in cognitive psychology that looks to explain some of these anomalies, and we're going to look at some. Overconfidence. We're overconfident about what we believe. We underestimate the risks. I love this one. Self-attribution bias. You take credit for your successes and blame the failures on others. Both of those cause investors to trade too often. You're too confident about what you know, so you trade more than you should. Ladies, men trade a lot more than women, and they trade more than they should. Loss aversion. We are averse to selling a stock that's gone down. We're more likely to sell one that's gone up to capture the gain. Bad move. Stocks that investors sell that have gone up perform better than the ones that you kept that went down. We don't want to admit to a loss. It's because you put too much emphasis on what you paid for it. I paid $20 for it and it's selling for $15. Oh my gosh, I'm going to lose $5. Well, if it drops to 10, you're going to lose more. You should have gotten out. Reference what it's worth now. Representativeness. This one, I put that in color. The human mind seeks patterns. That's true of everybody. Everybody's mind seeks a pattern. You're looking for the pattern there. Tendency to draw strong conclusions from small samples. underestimate the effects of just pure chance. Overreact to good performance, overestimate the likelihood that it's going to continue. I think everybody can see how some of this could happen to you. Underreaction. You may underreact to new information. You may look at it and just go, I don't think that's really going to happen. Narrow framing. You ignore the big picture. We got a couple more coming up here. Belief perseverance. Ignore information that conflicts with your existing beliefs. If you think the stock is good and you buy it, then you're liable to discount bad information, bad news about it. Anchoring. Individuals attempting to estimate an unknown quantity put too much weight on information they have, even when it's not relevant. In other words, you predict high growth in sales when you've seen high growth in sales. Not paying any attention to what's actually happening, but that's the history, so you think it's going to happen. I love this one too, and this one particularly, familiarity bias. You buy Apple because you like your iPhone without paying any attention to whether Apple is a good stock or not. You're familiar with Apple. Apple happens to be a good stock, but you buy something you're familiar with. Just because you like the product doesn't mean the stock is a good buy, or the company's even well managed, for that matter. They may just have stumbled upon a good product somehow. Now, the implications. It can lead investors to make systematic mistakes. And if you see that, you can trade on it. You can take advantage of it. Here's their table about improving results, but I'm going to get to it. Don't hesitate to sell a losing stock. Cut your losses. Don't chase performance. Be open-minded about it. You should review your performance frequently, and don't trade too much. Technical analysis. I happen to like technical analysis. And they do a lot of this in the commodity markets. There's whole books of it. It's searching the historical record of prices, returns, and volume, looking for patterns. Easy enough to find because the human mind wants patterns. Think about applying this not to stock, but to commodities, to like agricultural commodities. The patterns are clear based on the seasons. The harvest season. If the patterns repeat and you spot them early enough, you can trade based on them. It is very controversial. It is totally at odds with the weak form of market efficiency. Technical analysts argue that trading volume and price movements often reveal the market's future direction long before it's evident in financial statistics. I actually used some of this in my dissertation because I used volume, showing that, and there is some support on this side. Price changes show the quality of information in the market. Volume shows the quantity of it. So there is some support for that. They use charts. And we're going to look at some of the charts here. We're going to look at some of the metrics that they use. And a lot of these, they didn't give good examples, but we're going to see some in the end of chapter problems. The confidence index is the spread between average yield on high-grade corporate and on average corporate. There it is. Smart money says the trend of the market is revealed in the bond market before it is in the stock market. It's a positive sign. A rise in the confidence index is a positive sign. Market volume, investor interest. Increasing volume during a rising market is positive because it means more investors are coming in and bringing it up. When the volume begins to drop off, it may signal that we're looking at a change. That's easy. Volume's everywhere. Breadth of the market, the number of stocks that go up versus the number that go down, declines. You want to see more going up. Advances and declines, and we're going to look at the advance and decline lines in the end of chapter again. When advances are more than declines, it's a strong market. And again, that data is widely available. Short interest. Short interest is kind of on a two-sided thing. It's the number of shares of stock sold short at any one time. Now, you think that's a negative signal, and in a way it is. One interpretation, the bottom one, it's a weak market because professional short sellers are expecting the market to go down, so they're selling. But it can be positive because it guarantees future stock sales because they're going to have to cover the short. Personally, I go with number 2 there as being a negative signal. You're going to love this one too. Odd lot trading. Trading in less than 100 shares. That's considered a contrary opinion because they assume that small traders will do the opposite of what they ought to do. That would be us. That we'll panic when the market and sell when the market's low, and we'll speculate and buy when the market is high. So it's a contrarian viewpoint. Market technicians. There are a lot of these people. They believe that supply and demand drive stock prices, and they've got all these equations for it. They develop trading rules based on it, and some people have made a lot of money doing some of this. You have to think, though, you ever seen them where they're advertising my book on how to trade and make $1 million? Trust me, if I knew how to trade and make $1 million, I would not write a book about it. I would quietly go home and trade from my little computer. There would be no book coming out. Okay, what they like to see, they've got all these different trading metrics, and they like to see a bunch of them moving in the same direction. And we're going to look at them. The advanced decline line. Stocks closing higher, stocks closing lower. You plot it. If the graph is rising, then the market's strong. It's a signal. They use that as a signal to buy or sell. We're going to see some examples. They didn't stick them right in here. New highs and new lows. The difference between stocks reaching a 52-week high and those hitting a 52-week low. I think most of these are fairly self-explanatory. You could figure out, how they were doing it. 10-day moving average. You're looking for a signal to buy or sell, and we'll see some come up. When the highs are greater than the lows, market's strong. Here's your basic market data, advances and declines. Look up there. NYSE, Amex, NASDAQ, Amex was still open, and Bloomberg. Advancing issues, 28%, declining issues, 68%. Not good. But you had 76 stocks hitting a new high and only 39 hitting a new low. But the up volume was significantly less than the down volume. The up volume, I'm looking at NYSE, the percentages were pretty consistent with the advanced decline issues. So those are the kind of numbers you're looking at. Now, they call this the ARMS index. It's the trading index, a trend. It combines the advanced decline line with trading volume. And look what you've got. Again, we're going to see an example on the homework. Number of up stocks, number of down stocks, volume in up, volume in down. A strong market, obviously, is more stocks going up than are going down. So a higher trend is a weaker market. Mutual fund cash ratio. It's looking at how much cash mutual funds are holding as a percentage of their total assets under management. More cash is a good thing because they're going to have to make purchases, and their cash position is covered for people who cash in. So they don't have to go sell anything to cover a redemption. On balance volume. This is a momentum indicator again. What you're looking at is you're tracking volume. If the stock closes higher, the price, then you add the volume. It's a running total. If it closes down, you subtract it. The direction and the trend, it's not a value thing, it's the trend. And again, we'll see an example of that. Okay, relative strength index measures the security strength of advances and declines. This is kind of a short-term thing. Average price saying on up days, on down days. You'd only use that short term. And charting. I'm sure these are online now. Commodity Futures Trading Board used to print big books of them. You had to go to the library to get them. They're basically charting volume and price is what they're doing. There is some of them. You've probably heard them on TV actually talking about the support line and resistance. Basically, the patterns form, look at this one, resistance and support. The stock sees trading right in there. If it breaks out through resistance, that's a buy sign. If it drops below support, that's a sell sign. You can see all their patterns. This is a head and shoulders pattern, triangles, flag and pendant, consolidation triangles, and inverted saucer. There are hundreds of these. There are whole books on technical analysis. Charting, the moving average, everybody knows what a moving average is. It just smooths things out. Typically, I think we look at one in the homework over 10 days. You can do it over any period. This is the moving average of the stock. This is a 100-day moving average. The red is the moving average. The blue is the stock price. When the stock price drops below the moving average, that's a sell sign. When it goes above it, it's a buy signal. That was chapter 9. I don't believe in any other class we've looked at technical analysis or behavioral. If we were all presented with we all own the same stock. We all own shares in the exact same stock. We were all presented with the same piece of news. We would all react to it at a different time because we wouldn't all see it exactly the same way. Okay, let's look at the problems. Here's you're going to see the examples of how some of these look. I went back and looked, and they didn't have them in the chapter like examples of it. And then I thought, but we're going to see them right here in the homework, so I'm not going to worry about it. Okay, this is number 1. Compute the ARMS index for the S&P 500 over the following 3 days. There's the number of shares going up and the number declining, the volume up and the volume down. Here's the up versus the down, 350 divided by 150, and the volume up divided by the volume down. That's your numerator, that's your denominator, there's your trend number. A higher trend is bad for the market, so that was not good for the market. Okay, number 3 says, this is unbalanced volume. Compute the unbalanced volume 3-day period for a stock. If the beginning level is 50,000 and the stock closed yesterday at 25. I should have put 25 right in there, but I didn't. Okay. Well, make it look like the others. Come on. Okay, we start there. If the stock price goes up, then we add the volume to the previous one. The stock price went down, so we subtracted 120 minus 45. Price went up, we added to it. That's what you're looking for, is the trend. That's not one you can ask much of a question on. You just kind of have to see it. Number 4 says, below the figures representing the number of stocks making new highs and new lows for each month over a 6-month period. Here you go. Would a technical analyst consider the trend to be bullish or bearish? Okay. New high low, cumulative high low. High low, you add it to it. It's bullish, it's going up. Cumulative is going up. Going up, as soon as it drops, starts going the other way. So again, you're looking for a trend in the market. As long as things are moving up, it's good. When it starts turning, then you become bearish. And number 8 here. Oh, yeah. Number 8. You have collected the following new high, new low data. If you're a technician, are you buying or selling? Well, it's going down, 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 down. It went up. It's still negative, but the trend has turned. It's going the other way. That's what you're looking for, is a trend reversal. Here is this mutual fund. And then, calculate the mutual fund cash reserve, cash position. It is cash divided by total assets under management. You're looking for a number of 10 or above, 10% or above. So market is bullish most recent week and weeks 2 and 3, but then it trends down. And here's our moving average example. You find the closing prices for a stock you own. You want to use a 10-day moving average, so calculate it for days 11 through 20. Based on the data, are there signals you should act on? Okay, you're going to start with a moving average from 1 through 10 is right there. 2 through 11 is right there, etc., all the way down. Okay, when the stock price is greater than the moving average, that's positive. It is all the way down to right here. When it's less, that would be the change in the trend. I think you can see where all of these kind of work. They're all looking for a trend. You're looking for when to trade. I guess that would be it. When to trade, when to change my trade.